Good morning, ladies and gentlemen. Thank you for waking up on a Saturday morning and sitting in for this event. I'm sure you're all comfortable at home, with your cup of coffee, tea, and maybe even some of you with popcorn. So anyway, ladies and gentlemen, this is the new norm. We'll be having lots of meetings on the internet, and we'll be talking to each other over the internet as well. This has happened because of COVID. This has all put us from work in office to work from home. Now, in the past, the developed markets like the US, Europe, they've always thought themselves to be superior to Asia. But if you look at the hotspots, I think the people in Asia like ourselves have handled this much better than them. If you look at the number of deaths, you think that this is not yet over. The number of cases are rising. We are looking at more than 1.8 million deaths. It's just like a little war that's been happening around the world. But of course, all this will eventually end, and that will only happen when we have the vaccine. Now, this chart shows the vaccine tracker. As you can see, there are lots of vaccine on the way to be marketed. In phase 3, we have 20 approved. There's 3. So for the whole of this year, few things will be important, which is vaccine availability, procurement, funding, and immunization execution strategies. This will be the differentiating factors driving the recovery of key financial markets. Now, for the extroverts among the audience, I'm sure you're missing your social life. For the introverts, you're very happy you get a chance to work from home. But of course, if you look at the global mobility index, you can see that from the worst in April last year, people are starting to go back to the offices. I mean, governments in general will have to weigh lockdown fatigue as well as economic weakening. Of course, when you look at the table above, you can see the developed markets like the US, EU leading in terms of confirmed dose purchases. Even on potential dose purchases, they are always at the top. So with that clearly in mind, you can feel that although cases are higher in the US and EU, but we feel that the recovery will happen faster at the developed markets. Now, let me just run you through third quarter last year. As as it's very fresh in your memory, you will know that third quarter was the quarter where people started coming back to work. And as soon as people came back to work, the economy reopened, you can see that GDPs in most countries actually rebounded. But the rebound, of course, was uneven, depending on how the individual countries were handling the situation. So if you look at the table overall, none of us escaped from 2020 unscathed. Most economies were in the red, except for Vietnam, Taiwan, and China. Of course, the bigger economy, there was a lot of sadness because, businesses were affected. But those of you who are on this platform and likely invested in the market, you would probably end the year on a very happy note. Well, good news is that 2021, hopefully, will also have a happy year because we are looking at economic recovery overall. I think GDP growth in emerging markets, including ASEAN, is generally expected to be stronger than the developed markets. To make this happen, interest rates need to stay low. Now, on the US, I think we are very happy to know that the Donald is out and Biden is in. The good thing is that Biden is expected to have a more predictable and stable foreign policy. And I think this will be more beneficial for US trade partners. Of course, this is the start of his tenure. We are still a bit unsure on how the relationship with China will go. I think the immediate term for Biden is that he will concentrate on fiscal measures to ensure the US economy recovers. Now, if you look at the economy, I think the worst is over for the US. You look at the chart on the left, We have a wage growth chart by occupation. You can see that, although unemployment figures are still relatively manageable, you can see that wage growth has recovered. If you look at the chart on your right, you look at savings rate is pretty okay for the US. So overall, we think that robust consumer spending will likely sustain economic growth, as sustained recovery of the labor market has helped wage growth across broad skill groups. So that's very important for a broad-based recovery. Now, of course, vaccination is key. When you look at vaccination, the next thing you must remember is herd immunity. Now, we have taken this data from the Institute of Health Metrics and Evaluation. This is actually an independent global health research center at the University of Washington. And they believe that herd immunity will have to be achieved before life can return to normalcy. Okay, if you look at this table, you can see that for the developed countries, most of them will start reaching herd immunity sometime in end third quarter, early fourth quarter. Okay, bear in mind, herd immunity does not mean 100% immunity, okay? Because there's no way the production is quick enough to serve all the needs of the world. Now, if you look at this table, the US in particular will reach herd immunity very quickly in third Q. That's on the back of the initial infection acquired immunity followed by vaccine. If you remember the tables earlier, they have bought one of the most number of vaccines, and therefore this justifies them to probably hit the herd immunity much faster than others. Now, on liquidity, you can see that on the table on your left, liquidity is ample. And because liquidity is ample, the markets have been buoyant in the US. And what is the thing that's driving the markets is earnings revision. Remember the chart that we have seen where we have global recovery in third Q, the rebound. And that rebound was on people coming back to work without the vaccine. So imagine when people come back to work with the vaccine, we will see a stronger rebound, and therefore earnings revision will be upwards. Now, what do households do when they're all stuck at home? I think it's the same, not only in the US, China, and Malaysia. People put money in the markets. I'm sure you remember that, you were probably behind a screen to look at stocks. So household has poured their money into equities and mutual funds. And of course, mutual funds and ETFs, they have poured their money into the markets. And that's why you have seen the US in terms of the NASDAQ and the S&P 500 hitting new highs. Of course, the question in your mind is, are we in an overbought position? Now, if you look at the net long positioning in the S&P 500 actually does not look overbought. It actually still hovers below the 5-year average. Okay, the upside is still possible, especially when we are talking about earnings revision. Like I said, when economies open, we should see a stronger rebound versus what we saw in third Q last year. Now, China, start of it all, of course, they stopped it faster than the other countries. This was mainly on the fact that they had a stricter SOP. Okay, so when the recovery came, if you look at the table on your right, at the chart on your right, you would see that industrial production actually rebounded stronger for high-tech industries. Now, if you look at the performance of A-share sectors, you would see that the first half of the year, because of COVID, the sectors that outperformed were the defensive sectors. But second half, when China got their cases very, very low, you can see a cyclical recovery. You can see sectors with cyclical recoveries showing gains, consumer, autos, and banks. Now, if you look at the individual participation in the market, you look at the table, the chart on your left, you can see that margin trading balance is really on an uptrend. Look at share of buying on margin, it's also reflected in that way. So it's showing you that retailers or high net worth people have also poured their money into the markets. Now, if you look at institutions, foreign institutions have also been pouring money into China A shares, and they are doing it through the outbound stock connect. So a combination of a few factors, mainly one, the reopening of the economy, the government stimulus support, increasing China households, as well as foreign investors' participation have kept the markets risk on in 4Q. So we think that this risk on mentality will likely spill over to the first half of this year at least. Now, why would foreigners put their money in China? Very simple. In this pandemic era, we have just realized that e-commerce is very important. And China has the largest e-commerce names. We have the Tencents, the Alibabas, and then we need those guys who transport the things like JD.com, Meituan. So because of this, people are actually pouring into China A shares. Now, let's go back to our home country. Okay, I shall not talk about this chart. I think we have been updated daily by our friends or by the ministry. Now, if you look at GDP growth, this forecast was before the MCO came in place. We think that depending on how long the MCO lasts, there could be some room for downward revision in GDP growth. But again, we are hopeful. Our minister has told us that the first batch of vaccines will be coming in late February, early March. Now, private consumption. Now, if you remember, fourth Q, when things were so much better, private consumption actually came back in a big way. I think if you want to buy a luxury car, you go to mid-high-end restaurants, they're pretty full. So you can see that, money that's made from the markets plowed back into the economy. So consumer sentiment has been pretty good. But of course, with the MCO, we're all stuck at home again. But again, I would like to reiterate that when things pick up again, we should see a similar turnaround. Now, if you look at private investments, well, that's expected to remain robust throughout 2021 as spare capacity recovers gradually. Now, in terms of fiscal stimulus, I think if you look at it, you can see that Malaysia is starting to spend more than its peers. We are spending about Ringgit Malaysia 322.5 billion, and this is part of the budget and other announcements that's made by the government to cushion the impact from the COVID-19. Now, in terms of GDP, I think 2021 GDP will be driven by a few sectors, mainly consumption growth, pump priming. I think we can see that the government is trying to revitalize some infrastructure projects and, of course, external trades. You look at our technology stocks in Malaysia, they are all exporters, and they are, they will be contributors to this as well. Okay, OPR. Bank Negara has kept OPR unchanged since 7 July last year. I think Bank Negara will continue to maintain its neutral policy stance with key points in their statements. However, of course, nothing is permanent. If this situation is still data dependent, and there's a possibility that there could be one more rate cut this year. So in summary, for the economy, I would like to say that the pandemic is a key factor and vaccine is the thing that we should watch about. Herd immunity is very important for us to go back to normalcy. Well, in terms of the US, we hope that Biden should be more predictable than Trump. At least we will not be expecting tweets anymore. Now, in terms of interest rates, I think most governments are likely to retain it at low levels, to avoid any derailing of any economic recovery. And in terms of economic growth, first half will likely be soft. Like I said, vaccine needs to come in. The whole process needs to be done. before seeing a proper recovery in second half of this year. Now, moving on to equities. If you look at the table, it's pretty clear-cut. US was a clear winner. I think we had new highs for the S&P 500, the NASDAQs, they clearly outperformed Europe. Now, if you look at Asia, North Asia clearly outperformed ASEAN. I think that's very clear because if you look at Asia, we have tech names like the Samsungs in Korea, the TSMCs in Taiwan, Honhai in Taiwan, and the Tencents, Alibabas and all in China. So, Asian it was a bit lagging because we do not have those sectors. Okay, the KLCI 12-month journey, I would think that all of us were pretty depressed in March. Then our hopes went up and we ended the year pretty strong. I think all of us felt good at the end of the year for those who are participating in this platform. Now, in terms of record selling, I think if you look at the table here, you will see that Malaysian equities was really unfavorable regionally. We were the second largest foreign outflows after Thailand. And internally, when you look at year-to-date record outflows, 2020 was a record year. Now, if you look at this table carefully, you would probably see that I think foreign selling is pretty much exhausted. So any reversal would actually give a boost to the market. In the past, we always say that the foreigners could dictate the market, but 2020 was a special year. The market did well because of people like ourselves. Look at retail participation. It's a record high. Okay, because of excess liquidity, lockdowns, we saw all of you coming back. I think last year was fantastic. You have loan moratoriums, no restricted short selling, no IDSS, it was a one-way street up. But of course, this year, I think the next thing on your mind would be asking me, will the retail be as strong this year? I think retail participation would be a factor this year, but it may not be as strong as last year, mainly on the fact that we no longer have a blanket loan moratorium. RSS, restricted short selling, has restarted. You can see some glove companies have been affected by it, and IDSS may be coming back soon in the next couple of months. But having said that, retail participation is likely to be here to stay. Retail will come in either directly or through mutual funds. Now, high COVID cases, which is what we're having right now, I think will still be overshadowed by vaccine optimism. All we need to do is actually see vaccination being done here. And I think when that happens, sentiment will recover. And like quoting the minister, I think he has said that our first batch of vaccine should be here anytime in February and early March. So hopefully by then we could see some recovery. Now, in general, I would like to summarize the catalyst for 2021 for equities. I think the main catalyst will be corporate earnings. I mentioned in the earlier slide that economic recovery is definitely going to happen. It's just a matter of time. So when that happens, you would see analysts rushing to raise their corporate earnings even further. Earnings revision in general from the brokers out there range from as low as double-digit 10% to as high as 40-50%. So with higher earnings growth, valuations do not become necessarily expensive, and therefore values can be found. The second driver is, of course, retail. I've spoken about it earlier. I think this round, even with EPF, we do not think the impact will be as strong as the first round last year. Then, of course, positive sentiment arising from mass COVID vaccination program will be the key catalyst. The other thing that we're looking at is reopening of international borders. I mean, we are a couple of months back, there was talks about travel bubbles. Of course, that didn't pan out because places like Singapore and Thailand, they had an increase in cases. But I think recently all of you saw on your WhatsApp that the PM already had a vaccination shot. So it's a matter of time before they have it under control. And once they do, probably we'll start opening, a travel bubble with Singapore, Malaysia again. The other thing is that we're looking at is the potential fund flows back into emerging markets. I think higher risk assets like equity will be preferred to attain better returns. Of course, the other thing that would support the market would be the weaker US dollar, and that could also translate to a return of foreign interests. Now, the themes for half, we'll probably look at laggard plays. I mean, some stocks have rebounded strongly and continue to go stronger, while some stocks are still, at pre-COVID levels. So values will be coming eventually when earnings start to flow in again. Of course, the clear winner for last year is technology. I think technology has been proven that there's many legs to go. It is currently just undergoing a positive structural change. I think there are key drivers we're looking at 5G, electric vehicles, IoTs, lots of things. So therefore, I think technology will be in play this year. And of course, dividend yielding stocks. I mean, we always need to pepper the portfolios with some dividend yielding stocks. Then of course, once we have a bit of political stability in terms of the post-GE 15, perhaps we can see interest returning to GLC companies as well. And lastly, like I mentioned, we could be a beneficiary of foreign fund inflows. They could start making a comeback once they see some political instability concerns, as well as a stronger ringgit and overall attractive valuations. Just a bit of a run-up on the fixed income section. You can see that US Treasuries overall actually stayed resilient despite vaccine optimism. So overall, we still expect US Treasury yields to remain low on the 2-year to 10-year tenures. Back in Malaysia, we saw Malaysian bond yields spike on vaccine news in November, but have since rallied in December. So we still expect bond yields to remain low, especially on the 2-year to 10-year tenures, with more volatility on the long end. In terms of foreign funds, from the table, you can see that foreign inflows have been seen since March. Foreigners are still holding about 25% of outstanding MGS and as of end November last year. Our expectations going forward is that MGS and GII supply will be higher. We are expecting heavier supply of this to support the fiscal deficit. This may actually induce upside pressure to government bond yields. Now, in terms of corporate credit ratings, I think we expect it to be relatively stable. So, in summary, for equities, optimism over vaccine developments will continue to drive global equity markets. Improving corporate earnings. Okay, we are looking at double-digit returns, double-digit rebound in corporate earnings, and of course, retail participation expected to maintain strong, and hopefully, foreign inflows will be a supportive to the market as well. So we are expecting upside opportunities in 2021, but of course, the journey will not be, without its bumps here and there. Now, for bonds, we think that accommodative monetary policies to prevail, OPR to maintain around 1.75, but still a bit data dependent. We are unlikely to see foreign outflows unless global bond yields increase substantially. Overall, credit environment is relatively stable. Higher government bond supply expected to finance the fiscal deficit, and potentially less demand for government bonds from the usual institutional investors like EPF and banks. So bond market may see limited upside relative to 2019 and 2020, but the lack of selling pressure will see it remain supported. So overall, the risk to the market remains when the vaccines can be shipped out when herd immunity can happen. So when that happens, we believe that markets will revert to risk on again. So our preferred equity class for 2021 is equities. We like the US. Like I mentioned, US is not at overbought levels. We have a new president. Growth is on track. The second market we like best is also China. China has done a fantastic job. And more importantly, they have all the e-commerce platforms, the technology plays there. So that's where interest will be. And the third point that people are looking at will probably be tech companies. So tech companies, we will be looking at countries like Korea, Taiwan, mainly North Asia. So these will all be our preferred exposures for 2021. Now for bonds, we like corporate bonds over government bonds. We think that risk-free rates are almost bottoming unless economic recovery expectations reverses. So credit spreads are still relatively healthy for AAA and AA credits at 75 to 120 basis points. I think with this, we are okay for the presentation, and you can check out our site on where to invest for fund information.